Hi, I'm Peter Rose, founder of Longwood Currency Trading. When to cut your Forex trades early. In looking at your trading, win-to-loss ratio, your monthly gains and all that sort of stuff, and putting your trading into more of a long-term perspective as to what your metrics are telling you your long-term results are, you have to really be able to evaluate clearly in your mind the process that you're doing, and I guess the rationale behind that process. What are you trying to do? You're trying to make money, but you're also trying to make the maximum amount of money that you can and not lose too much when you lose. I've talked a lot about that early stage, entry stage risk management process, and looking at setting profit targets and how to manage that position within what I call the life cycle of a currency position, which comes right out of my 33-year career as a software engineer designing back office business applications, enterprise level internet business applications, where designing a computer application has different phases that you go through, and as long as you stay with the phases, you're chronologically marching your way through the solution to that problem. And so in trading, I simply brought that concept into my trading as the life cycle of a currency position: entry analysis, position management, and exit methodology. And you have rules to solve each one of those problems, and that's how you march your way through your process. So what I'm referring to in this video by when to cut your Forex trades early is that position management phase, where you're not wondering whether your position is going to go underwater and tank right after you enter. You already have a position, it's in profit, it's running toward a profit target, and you're hoping that it gets to the profit target. If you exit that trade before you get to the profit target, that's what I mean by cutting the Forex trade early. You're getting out before the profit target. Well, if your profit target is the profit target, why don't you stay with the trade until it gets to the profit target? In your entry analysis, you've determined, and I don't know what you're doing. Let me talk about what I do. I'm a day trader. I'm on a 5-minute time frame. And the particular major currency pair that I'm trading has a 5-period ATR. Okay, so that's the status I'm in. I've got 12 5-minute bars an hour that I'm trading against. And I'm looking for profit targets when I do my entry analysis of between 20 and 30 pips, and there's reasons for that. If I have low volatility, and that's relative, then I may be more apt to not look for the longer profit target, but for the shorter one, because maybe the price of momentum I feel can get there, but maybe it can't get 30 pips, but it could get 10 pips or 12 pips or 15 or 20. So do I have 20 there so I have a buffet of choices? If I have more high volatility, then the probability of that price going to the 30 pip level might be valid. I personally don't find that price, for the most part, 80% of the time on a 5-minute time frame, is going to go more than about 15 pips without a flip around. Now that flip can be 5 or 6 or 7 pips. It could be 25 pips. You just don't know. And that's where you have to be able to make the decision. Are you going to take the flip around and wait it out, and maybe you set a stop that gives you that guaranteed 3 pips? Well, look, when you're day trading and you're looking for 20 pip profit target, setting your stop so that you get 3 pips guaranteed when your open real estate is 20 pips and the price is already, maybe it's moved 5 or 8 pips up, and you set it 3 down there. Now you're at a 5 pip stop level, and you're going to get taken out. So when do you guarantee the 3 pips? You can't. You have to look at what price action is doing, and if it starts to falter, have your finger on the button ready to go, and when you get 3 pips, boom, you bang it out. If it's only 3 pips down to that level, to get the 3 pips, you got to go out in 3 pips, which is the spread, really. Yeah, well, a pip and a half, but yeah, you're getting pretty close, right? How fast can you move the trigger on bid-ask? So when we're looking at evaluating that position management price action, we have a profit target, but we can't get fixated about that. Sure, you can set a limit stop out at your target, and that's fine. You can go to it, particularly under the lower volatility things. You want to be sure that if there's a sudden spike, an anomaly, that you'll get hit. I just did that this morning. I was in a situation. I just had a ton of open real estate. I went in with a series of single full lots. I stacked them in there so that I had 5 full lots within about a 6 or 8 pip range. That's stacking a lot. But I was pulling a lot in as price would go back against me and do I was playing regression to the mean against this price down on a 1 minute time frame. I'm watching this price now on a 5-second time frame as well, because I'm loading up pretty heavy early on in a situation where I've already had extreme volatility. I was short, dropping this price. It had a retraction to the major mean, and now I'm picking it up as it's coming off that mean. I'm doing a reverse regression add, and that's how I got my 5 lots in that position. I went in, it went in my favor, I grabbed another one, it went against me, I grabbed one, it went against me again, I grabbed one, I got my 5. Now the thing is moving. Now I'm in profit. I'm $300 or $400 or $500 up in profit, and I added another lot, and then I added 2 more. I'm carrying 8 fulls, and the distance from the average position value to my take profit was about 19 pips. Now that's a long way, and yet I had so much open real estate that I felt I could do that. And I'm looking at the construction of the past price action volatility to determine the probabilistic likelihood that that volatility will continue based on some order flow analysis that I did. And anyway, I got it right, and picked up 19 pips on the A, so about $1,300. All that in about 10 minutes. I was brushing my teeth. I got up in the morning, I turned the trading desk on, I'm brushing my teeth, and I'm looking at the price action. I got to move, boom. I hit an order in, and before I stepped away from the computer, I looked at it. It took me 15 seconds. Okay, put the order in. Boom. The order goes. I was walking away with it. Then I come back and I look. I said, oh, I got good volatility. Boom, I hit another one. Then I set 2 more limits and finished brushing my teeth, getting coffee, and settling down and then coming back in. So in that case, I'm watching that price action, and I was okay with what I saw, and so I let it run. A few days ago, I made about $820, about the same time frame, but probably about 15 or 20 minutes, about 5, no, it was about 10 minutes, I think. 10 or 15 minutes. But my profit target was out at a point where that position size would have been a $2,400 gain. So I got out early. Why did I get out early? Price was moving in my direction, but it was moving slowly under very low volatility. And there were a lot of minor retractions on the 1 minute chart to, doing a very short mean regression. I looked at that, price is rolling away from that regression and continuing on. It goes past where it's the swing point. I put another, added another lot, because I knew that if I was to get a slowdown in price, what looked like a slowdown in price, I was going to have to get out. So I wanted to have as many lots as possible at a high enough or a far enough distance from my average position value so that I could exit out and get a good bang, which I did. I got $800 when I finally got it out, because I saw the price stagger first. I saw it begin to arc up and regress to the mean. It took about 4 pips off my profit, and I closed the trade, because I felt that not only was that going to do the regression to the 1 minute mean, but that I go out to the 5 minute and it could probably go up into there. So I got out. And in fact, it went up and regressed beyond that 5 minute point, which would be, it was about 7 pips, I guess. 8 pips that thing swung around and moved against me, which at that point was about where I had gotten into all this mess. That would have been my, I would have been underwater at that point. However, it did turn around, and it just dropped like shit through a goose. I was again short. Went past the swing point, and just, it was like a rock falling through the sky. And I'm sitting there going, look, I evaluated that situation as potentially not going to be in my favor. I did a probabilistic estimate, and I pulled the plug. I got out, I cut the trade, and I made, well, it was probably about I think I made 1.4% against my risk on that one trade. So I was happy. If you make 0.5% on a trade, you're doing pretty good. You are, if you could do a 1/3 of a percent, 3 pips 1,000 every day, you'd be doing just fine from a percentage return on your bank on an overall 200 trading day year. Do the math. So when is it appropriate to cut your trade short? When you evaluate that the probability is not even jump ball, but maybe 60% against you, or even flip it around, even if it's 40% against you, that price is going to continue to go all the way up. That's too much of a probability from a negative standpoint. Why take that probability? You're sitting with a couple of $100. In my case, about it was $950 or something like that. I was up, and I waited for the swing, and I pulled the plug and I got 800 bucks, 1.4%. And I knew that's about what my percentage return would be if I cut at that level. Why wouldn't you be happy with that? If I would have waited and that price would have gone all the way back to my entry level, I would have had to get out with nothing. And that would have been okay. But all we're trying to do is anticipate the price action from a probabilistic sense. Is it going to continue? Is it not going to continue? What are my probabilities? And you have to understand that that's what we're doing. That's what you do when you play poker. Don't tell me you don't understand math and stuff. If you're playing poker, it's all probability. The guy just put a raise in. I'm 3 cards on the hold'em flop so far, and what do I want to do? Do I want to call, raise, or fold? That's my choice, and I have to decide right then. So why would I risk a 2-time pop when my odds of getting bumped out are not that great, even from a positive expectation? Oh, I've got a positive expectation of 60%. Well, I don't know if that's good enough. Not playing poker and not trading. You have to have a better idea of the currency pair that you're trading as to what the probabilistic excess over the ATR is going to be when that price gets going under any kind of conditions of momentum. If you have that sense, then as you're watching the price decay against an open profitable position, if you pull the plug and you can get 0.3 or 0.5% against your risk, then you've made a good trade. I pulled it because it had gone so far. I was up almost 2%. Well, not 2%, 1.5%, 1.6%, 1.7%. Anything over 0.5% is great. Anything over the 0.8% that I usually get on a trade, between 0.5 and 0.8%, I'm going to grab that, because when it does turn around and it goes back in the direction that it came from, I can reevaluate it from an opening position and say, well, I'll get back in. In the case today, where I made $1,300, the thing turned around, it went back to where I exited the trade and was forming a little bottom, and I did a reanalysis. I jumped up to the 4-hour time frame to look and see what was going on a longer term basis, and I'm running into a lot of order flow resistance at that point. I'm done. That's where this cup of coffee came from, because I closed that down, got a cup of coffee, and thought, why not? Why not just talk about when to cut your Forex trades short? And I hope that you kind of get a sense of how to evaluate that, and don't get so fixated on the profit targets. The profit targets are a suggestion and what's possible in the trade if everything goes okay. All I'm saying is watch what happens if everything doesn't appear to be going okay. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.